Geoffrey Dennis is independent emerging markets commentator. He's with us now to take some questions. Geoffrey, great to have you with us here. It's not so much. Markets have been roiled a little bit, especially here in India and EMs, etc. US may be starting its leg lower. I don't know because that's been the strongest market by far, by some distance. So what's the dominant driver? Is it Trump and what he could do with tariffs, or it's just the underlying strength in the U.S. economy, which has brought back fears that perhaps 25 will see no rate cuts?
I think it's both, frankly. I think the market is very uncertain about quite what Trump will do in terms of the scale and the breadth of tariff increases. At the same time, we need to know what tax cuts he's thinking of doing. Obviously, the most likely thing is to prevent the sunset of the income tax cuts that he put in place when he was previously president. But the bottom line here is that if you look at what the market is concerned about with these potential Trump policies, they lead, in theory, everything else held constant, to higher inflation and a wider budget deficit. And if you combine that now with also this blowout employment report for December that we got on Friday, this is just contributing to higher bond yields and a stronger dollar. And as you say, significant risk now that the Fed may not cut rates at all in 2025. Now, I put my outlook out about 5 days ago on the 8th of January for the year, and my call is that bond yields go considerably higher from where they are now into the 5 to 5.5% range. I see the dollar continuing to strengthen from here for a while, and remains to be seen what they'll do on the interest rate front. So I'm not surprised we're seeing this decline in the early part of the year, especially for emerging markets. But obviously, as ever, it all depends on what Trump does, and it depends on what the economic data in the US will look like as well.
Geoffrey, just one point on Trump, and this was an interesting, I don't remember where I read it, but it stayed with me. It's essentially said that what we're seeing now is peak Trump. So he's not president yet, so he can say whatever he wants, and he can make all kinds of claims. I'm going to do this, I'm going to do this. But once he's in that seat, he's then president, and then he's bound by actually, first of all, doing things which will affect things, and there'll be first order, second order implications. There'll be a team around him. So in that sense, this is the peak. And in that sense, it'll get a little better once he assumes office. Does that make sense broadly?
Yeah, I hope you're right. It didn't happen last time when Trump came into office. Of course, he carried through a lot of the things that he was threatening. But one of the famous, as you will all know, market expressions is you sell the rumor and you buy the news. And when Trump comes in, it could well be that this signals a change of direction. But my worry here is that almost whatever he does, or indeed doesn't do, we have a major budget deficit problem developing in the United States. And I do think that while the economy stays strong and the budget deficit continues to widen, it's around 6% of GDP now, I don't see any alternative but for bonds to remain somewhat under pressure over the next several months. And I think that's going to be the big driver of markets generally. Sure, we don't exactly know what Trump will do. It's a shot in the dark. It's a gamble. But frankly, the macro trends generally are towards, as I say, wider budget deficit, inflation leveling out. I don't think this is good for bonds. I think it's strong for the dollar. And I think it's a tough environment for EM, as I said, I think on this program the last time I was on.
Mr. Dennis, hi, good morning. Absolutely. So therefore, my next question, given that it's getting so complicated, right? Now with the inflationary concerns in the US, these rising bond yields, we're seeing the rotation out of tech stocks, for instance. They're not rising in a straight line anymore, and the specter of maybe fewer rate cuts. So where does money move? Where do you see money moving in the next couple of months? Because, I would ask you whether it's going to come back to EMs because there are problems in America. But then EMs, we don't know who gets slammed with what kind of tariffs. So that's another complicating factor. Where do you see the money moving over, say, the next 3 months?
It's very hard to be sure about that. One of the interesting things is that we've had a very contrarian move in some of the big emerging markets so far in 2025 compared to 2024. So Korea is up a lot, having fallen sharply last year. Taiwan and India, as you know, and also China are down a fair amount. Brazil has started to rally. And so you've seen a bit of a contrarian move, which in some sense is sort of consistent, although different from what we've seen in the US with a rotation from tech stocks to elsewhere in the market. Through all of this sort of complicated, challenging start to 2025, what you've got to remember is that EM is still underperforming DM. EM's down about nearly 3% year to date. US is down a little bit. DM's down a little bit. So we need a complete change of direction, in my opinion, in terms of bond yields and the dollar. And in case of India, I think oil prices for the markets, the people to start putting money to work in EM, which could, of course, happen later in the year. But right now, I think finding pockets of strength is difficult. I would take a look at Brazil. I would take a look at Korea. I would take a look at other markets in Latin America, which did so poorly last year, although probably not Mexico. I would look elsewhere in EM, in South Africa, in Turkey, and I think despite the volatility so far this year, I still see the US outperforming Europe, where the macro situation is so poor now and seems to be getting worse.
Okay. All right. Well, let's see. We do live in fairly complex times. Thank you for joining in for a quick chat today, and we hope for more in the coming few weeks as well. Well, let's